Okay. The Inflation Reduction Act, it gives the IRS an additional $80 billion to spend over the next 10 years. 35 billion, they say, is going to go towards upgrading operations, and 45 billion is earmarked for enforcement. If you've ever tried to reach the IRS by phone, it's almost impossible. My advice to clients is always call at 7 o'clock in the morning. If you don't do that, then you may not, they've already reached their queue for the day. They promise that they're going, the promise is that they're going to, people earning less than $400,000, they're still, that's not who they're really going after. They're going after people above that range. And they're going to focus on cryptocurrency, S corps, offshore accounts, and business partnerships. They're really going to put an emphasis on tax notices and things to partnerships and S corps. But that's okay, as long as you handle your accounting properly, then we'll be all set. There's an idea what is real. Okay, sorry, I don't know what is happening. Arrow. Okay, so the agenda, first things first, the tax code is full of thresholds, phase outs, exceptions, exemptions, limits, and now extenders. There's a lot of things that are due to extend, say at the end of 2025. And an extender would be something that would pass the law so that it stays in the tax code, which I hope that we will have a lot of extenders coming up, things that help the taxpayer. We're going to evaluate the sole proprietorship, know your numbers, which is how I always begin a lot of my tax talks, making sure that you know your numbers going into the end of the year. We talked a little bit about the 1099 NEC and the 1099K, talk about a couple strategies to reduce self-employment tax, bonus depreciation, and hopefully as a small business owner, you the term QBI deduction or section 199A deduction is not foreign to you, because that's a really big tax savings for small businesses. We'll touch on retirement plans and how I always talk about evaluating your business tax structure in terms of, are you in that sweet spot where an S corporation makes more sense for you than a sole proprietor? Know your numbers. We're in the beginning of December, so I would say definitely print out your balance sheets and your P&Ls through November and take a look at them and see where you are. Your balance sheet, as you know, is what you owe and what you own. Assets less liabilities plus income less expenses is net worth. Always important to know your numbers. Your profit and loss statement is going to be your income less expenses, and that equals your net profit. Compare it to, a little typo there, compare your net profit or loss to last year. And then based on your anticipated profit, look to see how you think December is going to be for you. And then do a projection to know your federal and state tax liabilities. Important to keep an eye on state tax liabilities as well, because Connecticut, as you know, has 7% really tax rate. And to keep your financial house in order, prepare financial statements for both your business and your household. It does look familiar, like the tax code. It is a lot of, like I said, exceptions and exemptions. So you start at one end, I'll start at the other. Luckily, we really stay on top of all the changes that are coming down the pike. We always know what's going on. So just to refresh, sole proprietorship, right? It's an unincorporated business. The sole proprietor owns the business assets directly and has unlimited personal liability for any debts or claims against the business. That's why a lot of small businesses become an LLC, a limited liability company. That's really a legal term in terms of helping the owners shield themselves from business liabilities. A lot of times I ask clients, what is your tax structure? And they'll say an LLC, but really an LLC, you can be a sole proprietor, you can be a partnership, you can be an S corporation, so, and even a C corp. So an LLC is really a legal term. And again, at the end of today's topic, we'll talk a little bit about converting to an S corporation and seeing maybe if that's right for you, because there definitely are a lot of tax savings. Oh, sorry, let's go through that. All right, so a sole proprietor, you're going to report your income on a Schedule C within your 1040. That being said, your net profit is going to be taxed at ordinary tax rates plus self-employment tax. It's as if you're the employer and the employee. So you're responsible for paying Social Security at 12.4% and Medicare of 2.9% on your bottom line, on your net profit. Just like with a W-2 employee, your Social Security gets capped at $147,000. So after that, your self-employment income is only subject to the Medicare tax of 2.9%. And if that's not enough, then the this additional 0.9% Medicare tax cuts it, creeps in at about I think it's $200,000 for I think it's $200,000. I think I have a note later on with that. It's hard to keep all the thresholds in mind. You have to pay the self-employment tax. Now, the IRS does allow you to take 50% of that tax that's paid and report it as an adjustment. So it's not 100%, you're not paying it all. You do get a 50% deduction, but let's face it, it adds up. It really adds on to our tax. So what do we want to do is we want to be able to take all the deductions that we are allowed under the current tax code. Here is Schedule C for 2022. We could literally spend our entire 40 minutes just looking at this form. Gross receipts or sales. That's what we'll talk about the 1099Ks a little bit. We're not going to touch on it too much, but I know it's a big question out there. Line 1, gross receipts or sales. The IRS obviously is tracking 1099s now. So you never want that number to be less than what's reported on 1099s. You're going to get a notice. If there's items in that 1099 that are not taxable income, then you can report it. If it's cost of goods sold, you take the deduction. If it's something else, be clear about it, but don't reduce the number on line 1. Part 2, with the expenses, make sure you use all these lines that you can. Obviously, they're not all going to be here, and you're going to have to report other expenses, but do take advantage of the line items that are on the Schedule C. And it actually helps you too. If you read through this, if you have a tax preparer or whatever, obviously you want to read your own tax return, and you can see some of the expenses that the IRS is really anticipating from you: advertising, car and truck expenses, legal fees, professional fees, insurance, rent, utilities, all those kind of things, wages if you have employees that you pay out of your Schedule C. And we'll touch on it as well. There's a big part down here about home office, which is huge right now, right? A lot of us don't even have an office to go to. We're working at home. So if you have an office in your home that's exclusively used for business, then you can get a nice deduction for that as well. Don't assume you're taking too many deductions, like I said. And my number one rule for small businesses is, get your own business checking account, get your business credit card. Don't intermingle your personal and your business, because at the end of the year, when you're looking at it, it just, it's harder to look at it at the end of the year. Do yourself a favor, make the clean cut over to having a business business checking account and a business credit card. That way, all your expenses are captured there. And, a lot of the little things add up too. Don't leave deductions on the table. The IRS probably will expect in your first year, you're going to generate a loss for your business. Don't be afraid of taking a loss for your business. And sometimes, even if you've been in business a few years, COVID hit, there's lots of things that could result in a loss. Just make sure that you take the deductions that you deserve. You used to be able to carry back if you had a loss, which turns into an NOL on your tax return, you used to be able to carry it back. Now you can only carry it forward. Unfortunately, you can't get a deduction for 100% of your NOL. You can only take 80%, but at least you're able to claim that NOL in future years. What does this all mean? Never stop documenting your deductions and always claim all the rightful deductions. We've talked to so many business owners who just don't claim the appropriate deductions. And a lot of time it's because their finances are intermingled between business and personal. So if you haven't done that yet, make sure you start out 2023 that way. I think we talked about that in the gross receipts or sales, but it is really key to know that if that number doesn't match up, It could be more than your 1099s because some people do not issue 1099s. So your gross receipts can certainly be more than your 1099s total, but don't have it be less. It's the same thing for S corporations, partnerships, C corps. It's all like line one. Just make sure of that. As it says here, starting January 1, 2022, the American Rescue Plan Act replaces the more than 20,000 and more than 200 transaction threshold for third-party settlement organizations filing of 1099-K and replaces it with a single $600 or more reporting threshold. They think it's going to bring an additional $8 billion in new taxes over the next 10 years. So they're definitely going to start paying more attention to 1099-Ks. Definitely talked, I think, enough about it. I want to make sure that we get through all our material. My feeling is that if you have a business Venmo set up, chances are you're going to get a 1099-K. They say if it's a personal Venmo, you may not even see a 1099-K. And if you get one and you think it's an error, call the issuer of the 1099-K and have them issue a corrected 1099. Okay, so 1099-K, it's going to be things like, here's a few examples. Receiving payment for goods or services by PayPal, Venmo, or Cash App. My understanding, the IRS has not presented a lot of guidance directly from the IRS. So that's why I say this first year is probably, it's going to be a lot of testing and just kind of figuring it out, unfortunately, as we go along. Doing odd jobs, freelance work, that kind of stuff, or selling items on eBay if it's in a business account. That's our understanding right now. If it's a personal transaction, you're splitting the dinner check with friends, that will not be reported on a 1099-K when it's on a personal Venmo. A couple ways to reduce your sole proprietor net profit. One is prepay your expenses. You have to thank the IRS for that one. They allow you to prepay up to 12 months in advance without challenge or adjustment by the IRS. Specifically like rent, that's really the biggest one. It could also be for business insurance or malpractice or professional liability insurance.
What do you mean by prepay? Sorry.
Prepay, like if your rent is $3,000 a month, you can prepay $36,000. If you need that deduction on your Schedule C, if your income's way up and next year you don't think it's going to be that much, you can play around with that. So you could send it out to the landlord December 31st. You could send him a check for the whole year of rent, take the deduction, and he's not going to. So if you're on a cash basis, the landlord, I say he, but the landlord's not going to receive it until the next year, January. So they're not going to report it until next year. But you can claim the deduction, even though you paid it. There's actually a provision in there that you actually would not put that. If you were going to issue a 1099 to your landlord. So that's a good one. It depends on what is going to be next year. So it's, just one of those things to keep in mind. Stop billing your customers if your income is, if it's like December 15th and you're like, oh my gosh, like I didn't really spend enough time looking at my numbers and look at now I got to pay in all this tax. You can stop billing customers via a cash basis. So you can send out the bills in the beginning of January. For example, Jake, a dentist, usually bills his patients and the insurance companies at the end of each week. This year, however, he sends no bills in December. Instead, he gathers up those bills and mails them the first week of January. Presto, he postponed paying taxes on his December 2022 income by moving that income to 2023. Buying office equipment, etc., like a business vehicle. That's been one of the real blessings of the tax code is the 100% bonus depreciation. Unfortunately, that's going to start phasing out at the end of 2022. Right now, it's 100% bonus depreciation. And perhaps you've heard the term Section 179, which is another way to fully write off in depreciation in the year that the office equipment or vehicle has been placed in service. But unlike bonus depreciation, unlike Section 179, you can actually generate a loss with bonus depreciation. Section 179, you cannot. Section 179 will not allow your net profit, to go below zero to get a net loss. So that's going to be a big one because that's a really big tax savings for people who, if they need a new like I said, into any new office equipment, computer equipment, those in, landscaping and things like that, they're big machinery. They can do that by the end of December, and then we'll be allowed the 100% bonus depreciation, but unfortunately, starting in 2023, that goes down. I think it's 80% in 2023, and then goes down from there. Let me make sure that there's nothing else I really want to. Oh, yeah, the bonus will only be 80%, and then each year it gets scaled back a little bit more. So that's a big one. That's a big one to be losing. But hopefully, maybe they'll change it. Hopefully, one idea to also reduce self-employment tax if you're married and you can rent real estate from your spouse. So what happens, like with rental income, that's reported on a different schedule in the 1040, and the bottom line is not subject to self-employment tax. So if you say you paid your spouse $10,000 for rental income that's in their name, you can move that $10,000 over to Schedule E, which won't be subject to self-employment tax. But if you don't have that deduction, then you have to pay self-employment tax. So it's like one of those, if it works for your situation, it can actually be very, very beneficial because, like I said, rental income is not subject to self-employment tax. And hopefully that makes sense to you. I hope that you know that with the self-employment tax, because that's the biggest piece about being a Schedule C, right? Is that you're paying ordinary tax rates on your net profit, and you're also paying basically payroll taxes as if you're the employer and the employee. So we're looking for ways to reduce your net profit on your Schedule C so that it can reduce the amount of self-employment tax that you have to pay. Yeah, caution, obviously you want to make sure that all the documentation is correct. Name of the spouse, written lease agreements, executed at fair market value. 1099 miscellaneous should be issued for rent, and then you should be good to go. Obviously, documentation is key for whatever tax strategy that you are implementing. And rental income is subject to net investment income tax, subject to a 3.8% tax. That's another additional tax that I think it was the Tax Cuts and Jobs Act of 2017, where your investment income, if you have capital gains, interest income, dividend income, if your taxable income is over a certain threshold, not only are you subject to ordinary tax rates, that piece of that income is also subject to another 3.8% tax. So you may have heard like the capital gains rate maxes out at 20% for certain things. Let's just say stock sales. So if you have a capital gain, it's going to, depending on your income level, it's going to be 20%. Now there's an additional 3.8% on top of it. A timing income to minimize self-employment tax. That's actually a really, in terms of timing your income, to look at that threshold for 2022. The threshold for Social Security and Medicare is $147,000. In 2023, it's about $160,000. So any earned income above that limit is not subject to Social Security tax. So you may want to take that income into 2022, because then it's not subject to self-employment tax if you max, if your net profit is over $147,000. So as you can see, it's a lot of projecting, and the only way that you can project is if you know your numbers. And if you wait till the end of the year, it's really too late. So my suggestion is really to look at your numbers monthly, and certainly mid-year, and then at the end of September, and then again in December, to see if you could take advantage of any year-end tax planning. But if you are in that sweet spot of your income being in excess of $147,000, you may want to take that income in, because then it won't be subject to at least the 12.4% of Social Security tax. Remember that Medicare is different. It's going to be taxed no matter what, at least additional 2.9%, and perhaps even higher than that. I want to make sure, because I did write down a couple notes. I wanted to make sure that I covered what I wanted to so far. Yeah, I think so. Yeah, we talked about the 1099 for the landlord. You wouldn't, if you did prepay your expense rent, you wouldn't have to put that in the 1099 to them. Okay, cool. Let's see. This slide, we're not gonna talk too much about, but I want to let you know as self-employed individuals, there are different tax savings if you hire your spouse or children, depends a lot on ages and things like that, but there are ways to implement strategies to hire family members and be able to sometimes exclude it from Social Security tax, that kind of thing. So it just depends on who it is and some other factors, but we won't get into it, but I just want to make sure that you're aware of it. And then you can always, check out on irs.gov. I find that one thing that the IRS has been doing a better job on is their tax topics and things that are on their website. You can actually understand them. It's not like you're delving into the tax code and saying all these regs and all that kind of stuff. Section number, this, the parentheses and paragraphs. They really are, especially for small businesses, self-employed individuals. They have like a whole nice little section where it really does a nice job in trying to explain complicated topics that are full of, like we said, phase outs and thresholds and all those kind of things. Section 199, again, that's how I started out talking about the qualified business income deduction. That's one of the best things that came out of the Tax Cuts and Jobs Act. If there's two types of businesses for section 199A, either you're considered a trade or business or a specialized service, which accounting is in the specialized service, engineering, medical field, some types of consulting. They are saying those are specialized services that's based on like your reputation and knowledge. So they limit the amount of QBI deduction that you can get in those fields. I'm not sure why. They did let real estate professionals slide by, and they consider them trade or business, and also architects. So it's kind of strange how they pick and choose who's in that specialized skill basket. This is where thresholds and phase outs are. That's where you need, if you're in this situation and you want to understand it more fully, a tax professional can definitely help explain it. But it's definitely based on a lot of phase outs. For instance, if your taxable income, this is 2022, if your taxable income, that's not just your net profit from your Schedule C, but your taxable income that would include your Schedule C, if your spouse's W-2 income, or if you have W-2 income, rental income, investment income, capital gains, all that kind of stuff. That's what your taxable income is. All those things taken into consideration, less if you're taking a standard deduction, itemized deduction, that's the number that they're looking at. You have to look at your type of business, which I said, either you're considered a trade or business or a specialized service. And wages paid, that's another big piece of how to calculate your 20%. If your deduction amount is less than 20% of your QBI, then consider ways to reduce your taxable income, because that's the number that they're going for, not the net profit of your Schedule C. One strategy is to harvest capital losses. Actually, we're talking to a lot of our clients about harvesting capital losses in 2022. And if you do, as a side note, if you do have a lot of investment income, capital gain, realized capital gains for 2022, request from your broker a 1099 through November. Morgan Stanley, a lot of, we're loving it this year because it really helps with tax planning. They're sending, it looks exactly like a 1099. It just says, it says stop, like do not use this for tax filing. This is only through November, but it's very helpful if you do have a lot of capital gains or investment income to help you project what your tax liability is going to be for federal and state. So harvest your capital losses because your capital gains add to that taxable income number. So you may go over the limit and not be able to deduct that 20% QBI.
Well, you mean if you're tapping into them, or
what's that?
You mean if you're tapping into them, if you're cashing them, or just in general?
Well, capital gain. Well, there would be realized capital gains. So it would be stock that you have sold.
The one that you have sold.
Yeah.
Okay.
Any realized capital gains. So if you harvest some losses where you think, let's just get this off our
Yeah.
portfolio, that can help decrease your taxable income, which would then allow you to take more of the QBI.
Yeah.
So
but
it's a
they're
nice,
staying, then they're just staying. You're not doing anything.
right, yeah. If you don't sell them, then they're unrealized and they are not taxable. They did talk about that. I don't know if anybody heard about that. They were talking about taxing unrealized capital gains. I don't know how they would ever be able to implement that, but never say never.
Too many moving pieces.
Never say never. Second strategy that could be helpful in maximizing your QBI deduction would be making charitable contributions. Again, that would reduce your taxable income, thereby allowing more of your 20% of your business income to qualify for QBI. It's the easiest way to increase your itemized deductions to begin with. Obviously, we all want to be philanthropic and help people out, especially at this time of the year. You can't take charitable contributions unless you itemize. So either you take the standard deduction or you itemize, right? So itemizing would be any excessive medical expenses, state and local taxes, which has been capped at $10,000. So it doesn't matter if you pay $10,000 or $50,000 of state and local taxes, being both income tax, state income tax, and real estate taxes. You can only deduct $10,000. That changed during the Tax Cuts and Jobs Act as well. It was a big one. We had a lot of tax changes. And then buy business assets, what we're talking about, the bonus depreciation that for 2022 still in place, 100% bonus depreciation. And if you're starting out as a new company, that bonus depreciation can generate a loss and you're allowed to take that as a loss. Going forward, 80% bonus depreciation for 2023. And like I said, they phase out in future years. And do you want me to talk about bonus depreciation anymore? Are you guys pretty comfortable with that? Okay, so let's save that we'll save our time for other topics. Establish your 2022 retirement plan. The clock continues to tick and your retirement is 1 year closer. So do you have a retirement plan in place? If not, and you have some cash that you want to put into your savings for your retirement, then do that soon so that you can get a 2022 deduction. I put this little chart in here. I'm happy to send it to anyone who would like to look at it more closely. Bradford Tax Institute is, I'm a subscriber to that, and they're really helpful for small business owners, really just giving examples and scenarios and making complex tax situations easier to understand. So this is one of the charts that he provides, and it's about your options for retirement plans when you are self-employed and have no employees. So we won't stay on it too much, but these are your options: sole proprietorship and partnership. These are the options available to you if you're self-employed and have no employees. The easiest one is a traditional IRA, which I'm sure we've all heard about. Those have income limits, and so doesn't Roth IRA. Roth IRA has a lot of limits where you can't contribute to a Roth IRA. Traditional IRA, 6,000, 7,000 if you're 50 or older. Popular ones right now, the SEP IRA can, as you see in that, the maximum employer contribution, like this is a deduction that you can actually take on your tax return, up to 20% of your self-employment income, but not to exceed $61,000. It's a little more, obviously every calculation, we're trying to simplify it as much as we can, but obviously there's some things that need to get plussed and minused to come up with that exact number. 401k is solo 401k, great option as well for sole proprietors. These two have to be, the SEP IRA and the 401k have to be set up before December 31st, 2022. We did get a little grace period for 2020 and I believe 2021 where they actually allowed you to set it up under the Secure Act, allowed you to set up a retirement plan after the year ended, which was it was unheard of. It never happened before. Now they've gone back to the regular method where you have to set up the retirement plan by the end of the year. You don't have to fund it, but you have to set it up. You have until, for the SEP, I think I wrote it down. So the traditional IRA, you have to make the contribution before the original tax filing date, which this year will be April 18th. The 15th is on a Saturday. So that traditional IRA contribution has to be made before the original tax filing date, which for individuals will be April 18th. The SEP IRA and the 401k, you can make contributions up to the deadline, including extensions. Obviously, you have to put your tax return on extension, which we do a lot with our higher income individuals who have a lot of moving pieces and we don't have all the information. We automatically put them on extension. They won't have to fund their retirement plan until the tax return is due, including extensions. The simple IRA, it's a great mechanism. It does need to be set up before October 1st. So unfortunately, that's out for this year, but that's definitely growing in popularity and helps small businesses be able to fund their retirement plans.
This would be great if you can send this.
Yeah, for sure. If you are an S Corp, we're gonna hopefully want to make sure we have time for questions and everything else. This is for S Corps and C Corps. These are the options available when you are the only employee. Because as an S corporation, you are now a shareholder employee where you actually pay yourself reasonable compensation on a W-2. Home office deduction, like I said, that's really big. Obviously, this year, you need to create an office in the home as where you perform administrative and management duties. You are actually, I want to go, let's see if it's the next slide. Following points. The administrative office is a principal office. You must use this office exclusively for business. You have to use the office regularly for business, and you must do your admin in the home office. You must not do the admin work outside of your home, but you actually can have maybe it was on the slide before. It gives you okay, so the test, you have to make sure it's for admin and management fees, and you don't use another fixed locations to do substantial admin work. It gives you the opportunity to do several things. Create an office in your home as an administrative office, have an office outside of the home for business activities other than your admin activities. And I haven't tested this one yet, but I think it's great. Then you can deduct as business trips, the trips from home to your outside the home office and back, which, right, commuting costs were never deductible. So that is a slight relief for self-employed people to be able to use home office and to have an office outside of the home. And that on the Schedule C that we brought up earlier, that's handled on the bottom part after we saw all those, advertising, insurance, all that block of expenses. Then underneath that is where you work on your home office deduction in conjunction with another form. I believe it's 8829 that actually goes through the whole calculation of, if you own your home, what's the mortgage interest, utilities, whatever the expenses are for your home, then you prorate the amount square footage that you're using as your office, the square footage of your whole home or apartment, and then you come up with your percentage to help you determine how much is allowed for deductions. Home office deduction, pool table in the room. It was a kind of a funny court case that they have a pool table in their office, and they use the pool table as a surface to frame their photographs and photography clients. But they also have people come over to play pool. So you have to be very clear. The IRS wants to be very clear that office is being exclusively used for business. So pool table in the room, unless you're never using the pool table, is going to be hard to get by the IRS. And I have never personally had any notices or anything relating to a home office allowance. I mean, right? I think post-COVID, they're not even going to know, because it's not like they're making any
Who has a
visits, home
dedicated
visits.
actual office room?
I know. Yeah, so you just have to be careful. You just have to be careful with it, with the deduction. And there is a simplified home office deduction, which I believe is, it was a total of $1,500. You could just claim that regardless of, not going through the whole, like, what's my mortgage interest, what's my utilities, what's this, what's that. So you're able to get at least a slight deduction that way. And you can't deduct Starbucks as a workspace, so that we can't do that. As much as we try. You can deduct the coffee if they're there meeting a business colleague talking about business. Converting to a Roth IRA, it's a little bit outside of the scope of self-employed, but not really, because if you have a traditional IRA that one day you're going to have to receive required minimum distributions on, if you find yourself in a low income year, you may want to convert some of your traditional IRA to a Roth IRA. You will have to say you're going to convert $30,000 from your traditional IRA to a Roth IRA. You will have to pick that up in income in that year that you're converting it as the traditional IRA to the Roth IRA. But if you're in a low income year, then your tax bracket is lower. So it's a nice planning opportunity for people who find themselves in a low income tax year. How much should you convert? That really, you have to do some projections and see where that sweet spot is, so that you can take advantage of that. The 1099, this might not be in the best order. Yeah, I guess it is actually 1099, 199A implications. Consider the impact of W-2s that you pay out of your business, the ability to take the 199A, because especially if you fall in that specialized skill group, you can actually use W-2s to your advantage to get back some of that qualified business income deduction. I know it's really complicated topic, but just keep it in mind. That's what I'm hoping is you just take away some nuggets of information today, that when you're getting your stuff ready to do your taxes this year, you're going to be like, oh yeah, that's right. What about my section 199A? Read your tax return, look at the line, it's right on page 1, qualified business income deduction. Make sure there's a number there. If there isn't, then ask your tax preparer or look at to determine why there isn't. If you're in that sweet spot, or not so much a sweet spot because it's a phase out, if you're going to be losing some of your 199A deduction and you have independent contractors, should they be reclassified as employees, which is a whole nother topic in itself, right? Differentiating between an independent contractor and an employee. And really, should you consider converting to an S corporation? It's actually one of my favorite topics to talk about. We probably don't have quite enough time to spend discussing all the ins and outs of it. I think I have a nice slide here that actually helps converting to an S corporation. So by now, I hope we all understand your Schedule C income, your net profit. Not only is it subject to ordinary taxes, income taxes, but it's also subject to self-employment tax. When you convert to an S corporation, you pay yourself as the shareholder employee, you pay yourself a reasonable compensation, and that's going to be reported on a W-2. The rest of the profit is not subject to self-employment tax. So obviously you can see right there what a big tax savings that can be, depending on your net profit. With a schedule, with an S corporation, it is a separate business entity, so a separate tax return has to be filed, and then as a shareholder, you're going to receive a K-1 showing your share of income. You have to make the election. It's too late to do it for 2022. You have to make the election no more than 2 months and 15 days after the beginning of the tax year. The election isn't to take effect. So we are doing this for multiple clients of ours. And so we will be, over the next month or so, before it gets busy with tax season, making those conversions. Most cases, you're going to need a new EIN, which I know sometimes is a pain because you have to change it with so many, your bank and everything else. I get it, but you could be saving a good deal of tax money. So it's definitely something you want to look at. You should hire a business attorney to help you, because you will need an operating agreement. And you always have to remember to do your state registrations. And again, with the S corp, you're going to receive a K-1. What are the top benefits of it, of an S corp? Like we said, retaining, the bottom line's not going to be subject to self-employment tax. The states, most states have signed on now. We touched on the itemized deduction, the cap of state and local taxes at $10,000. Well, you could be paying $50,000 of state income taxes and you're not getting any benefit of it, but the states are now allowing the S corporation to pay the taxes at the entity level. Thereby, the S corp gets that deduction for the income taxes paid. So you're saving a ton of money right there that you would lose if when you're a Schedule C. That's a big one. You would pay yourself reasonable compensation, and that is not really clearly defined by the IRS. It's really, prevailing market rates, individuals' knowledge. The salary has to be paid, so you actually have to make the checks out, and it's a matter of interpretation. It could be the number of hours worked. Another approach is to examine a comparable salary or ask a headhunter what it would be to replace, what it would pay to replace yourself. Most of the time, and an average S corporation, we're not going to put the reasonable compensation over that FICA number, right? 147,000 for 2022 or 160,000 for 2023. So depending, unless it's a multi-million-dollar S corp, that's probably going to be reasonable enough. And you don't have to pay yourself weekly or monthly. Like, you can literally write yourself a check in December for that whole amount if you don't know how your year is going, because as we know, sometimes we don't take out enough of our own businesses. But you would also be able to take a distribution as an S corporation that wouldn't be subject to taxes. We're wrapping up now. This last slide I think is funny. Tax simplification, right? That's what we keep hoping for. I will gladly find another career if we could have tax simplification, but don't walk into your tax preparer's office like with a big box of tax stuff like that. So hopefully you've taken away some nuggets. I know we talked really quickly about all these topics. Really, my intent is for you to just be familiar with tax terms and gain a little bit of knowledge on how self-employment tax income works, how the self-employed individuals are taxed. And it's really been fun talking to you, and I really hope that you guys took away a little bit from today.
You can follow up with Treacy if you like. Thank you, everyone.
Thank you. Thank you so much. I really appreciate it. Thank you.